Hello Sector Watchers, welcome to the show. This is the 114th episode of Sector Spotlight for Tuesday the 8th of February, recording it on Monday the 7th. My name is Julius de Kempenaer and I'm presenting to you from Amsterdam in the Netherlands. Last week we talked about monthly charts and we pointed out a few of those nasty reversals, and I think I voiced a little bit of a concern with regard to the stock market. This week we're going to look at shorter term segments. We're going to look at last week's rotations for both asset classes and sectors. We'll start with the daily rotations and look at that short term performance, but then we're going to focus on the weekly charts and see what the trends there are doing in terms of relative strength, relative rotation and price performance. And if we look at the agenda, we can see that there are a few interesting asset classes charts. We're looking at the commodities, we look at SPY, we look at GOV and IEF. I think there's a big thing going on in the bond market. And then in the sector universes, we're going to look at communication services, energy, financials, tech, healthcare, and of course, consumer discretionary. As usual, we start our overview look back with the asset allocation, with the various asset classes. We have the weekly RRG on the left hand side and the daily RRG on the right hand side, showing you the rotations of a number of asset classes. If we take a quick look on the right hand side where we see last week's rotation, we see the strong performance of commodities despite the down pointing tail, losing relative momentum. This was still the strongest asset class, and you can see how far it is to the right. So this is qualified as a pause within the existing uptrend, fairly clearly in my opinion. Now, stocks, SPY was up 1.5%. That was better than the benchmark, which was up 0.7%. And you can see SPY inside lagging, but picking up relative momentum. Not a lot of relative strength, not a lot of RS ratio improvement here on that daily scale. And then you see the rest of the universe, which is real estate. It's in line with the S&P 500. It's in line with stocks. These are pretty much the risk-on asset classes. I think commodities could be classified as a risk-on as well, but traditionally risk-on stocks and real estate, and then risk-off is like all that fixed income related stuff like high yield, corporate bonds, government bonds. They're all rotating downward and they're followed by the US dollar. This is the picture over the last 5 days. So how does that relate to the weekly image? That's on the left-hand side. That's showing you a pretty different image, I would say. Again, we don't need to spend a lot of time on commodities because they are the strongest asset class at the moment, the commodities as a whole. There's no doubt about it. Look at GSG powering off into the leading quadrant, DJP following suit. These are strong rotations. Now we have the US dollar moving into leading, and further there you see that the last week was not too strong. The segment here was a little bit smaller, and that explains that drop here on the daily RRG. We'll have a look at that dollar chart later on when we talk about individual asset classes, because it's kind of interesting. On the other hand, we have high yield, we've got government bonds, we've got corporate bonds. They're all still on that positive trail, that positive RRG heading inside the improving quadrant, moving to the top right hand. And that's what you want to see for an outperforming asset class, which is what they do over time. Now you can see that right here. They're all above, except the corporate bonds. They are sort of in line with the balanced index fund, the other two. And this is a good example because these are they lost value. High yields lost 3.4%. Government bonds lost 3.5% last week, over the last 5 weeks. But that is better than stocks who lost 5.5%. So don't be fooled by the fact that something is going down and still at a strong heading or even inside the leading quadrant. That's all about the whole relative thing that RRG is all about. The tail for stocks for the S&P 500, that's in orange here. You can see that that is now rotating into the weakening quadrant, and the heading is moving further in a southwestern direction, which is a negative rotation. And real estate just lost its positive heading and is now rolling over, starting to move towards the weakening quadrant. Now, there are a few individual charts that I want to discuss with you, because there's on an asset class level there are some interesting rotations going on. Let's kick off with the commodities, because let there be no doubt that commodities probably right now the strongest asset class in this universe. Look at GSG. That's the GSCI Commodity Index Fund. It just broke above a multi-year resistance level, and it's moving higher, and there is plenty of upside. First resistance, I would say, is around 22. If you look at the relative strength here, that is still picking up, and you see that rotation on the RRG. This depicts here where the RS ratio shaved off that 100 level. That's the rotation that you saw here, where the tail just turned back up while it was inside the weakening quadrant, back to leading. Those are strong rotations, we know that. Here is the underlying index, $GNX, GSC Commodity Index spot price. It's even more pronounced, series of higher highs and higher lows, break above its previous high, and relative strength powering higher. If you look at DJP, kind of similar. There are two different, the difference between those funds is the weighting of, especially the weighting of the energy group, but the overall picture is pretty much the same. Here also you see DJP breaking out above a multi-year resistance that already happened at the start of last year, and we're doing it again. And if you look at this, sometimes when you annotate these charts, you go just like, wow. I mean, we're touching this here. The high here is 30.98, and the high here is 31. That's 2 cents difference, and there is 1, 2, 3, 4, 5, 6 years. I mean, I think this is a thing of beauty when a market does something like that, when it responds so well to these levels. And that's even I could say it's an outlier, because that's only one shot up during that week. If we look at SPY, then the story is slightly different. Here's the weekly chart of SPY. And remember, SPY is now rotating at a negative RRG heading. This is the chart that we've been maintaining here in Sector Spotlight for quite some time already. That negative divergence came back. We announced that, we noted that. It never went in the MACD. That negative divergence is still there. We saw that dip to 420, and then we had that rally, and I gotta admit, I was kind of like, wow, did I see that really, really wrong? Are we gonna be fooled by the market? Was this the low, and are we now gonna shoot higher as if nothing happened? I don't think so. If you look at what happened last week, we peaked at 458, which was sort of against that old rising support line, which is now acting as resistance. It's pretty close to that 460 area that you had. There's a lot, it's on the daily chart. If we move to that daily chart, you can see here, there was that outlier on the 10th of January with a low at 456.60, and we peaked last week at 458. That's 2 points difference. And you can see that here on the daily, that series of lower highs and lower lows is already in play, and it looks as if we set a new lower high last week. So this week is going to be pretty crucial to see what's going to happen in the near future for the S&P 500. I think that the prevailing trend on the daily chart right now is a downtrend, lower highs, lower lows. If you look at the weekly, we've definitely broken the uptrend. I'm not sure whether we have set a first lower high. That still needs to happen. But the first signs on the daily are there. What is a confirmation? I think if we take out the low of, that was last Thursday, is that right? No, Friday, 4th. So that was 443.80. Let's say 444. This high was 444. So that 444 area is now going to be pretty important. If we take that out to the downside, then we are, we could be in for a move towards 420, 425. If we break that, I hope that we see each other again before that happens so we can discuss it. Anyway, I think the ease of movement for the S&P 500 right now is to the downside. The upside is littered with resistance levels. So that's going to be a difficult story. If we're not going down, at best we're going sideways, I think, right now. The big story, I think, is coming from the bond market. If you look at GOV, you can see that we discussed that breakout a few weeks ago already, but basically we've been discussing it on an ongoing basis. And last week, again, we dropped lower. We pushed to new lower levels. And if we bring in IEF, which is the 10-year segment of the yield curve, 7 to 10-year bonds, then I was annotating these charts and I thought, wow, is this really what it looks like? And I just annotated it like that. And you can be the judge whether this is correct or not. This looks very much like a head and shoulders top. We had an uptrend, so it's the right position for a head and shoulders top to occur. We're rolling over, so this would be the left shoulder. The top, the head, is a very clear double top formation. Broken down, moved lower, so that is a nested formation. Now we formed the right shoulder, and now we broke down at the start of the year, and we're now following through. And if this really is a head and shoulders formation, and it's got all the characteristics of it, then we are actually looking for a target around 102, 103 for IEF. And what does that mean for yields? We got to look at the 10-year yield chart. So dollar USD 10 years, that's the inverse of IEF, pretty much the inverse of IEF. And it looks quite similar on the downside. So here we have that same head and shoulders, but now flipped over. Here it's a head and shoulders bottom formation. We clearly broke that neckline. We're moving higher. And if this all plays out as it is suggested, we're looking at yields around 3% for 10-year US bonds. And that's a level that was last seen in 2018. That's 3 years ago. And I think that could have a pretty big impact on the performance of the stock market. Now, another asset class or another asset where it has an impact is the US dollar. And here it becomes slightly confusing, at least for me, because normally, you would expect when yields are on the rise that the currency rises. And the US dollar was doing exactly that until last week. And last week we discussed how nicely the US dollar or euro dollar broke out of that consolidation pattern and started moving lower. And then all of a sudden we got that big swing up last week and we pushed it out of that trend channel, or suggesting it's moving out of that trend channel. We're still okay-ish as long as we remain below 115, I think. But it's worrisome, and that's what I can't really match with that fast rise in rates, in yields for US Treasuries. So I'm keeping an eye on that. So all in all, it looks as if the stock market is under pressure, the bond market is under pressure, but less than the stock market. So your preference should be for bonds or cash if you don't want to lose any money, because bond markets are still going down. So if you buy IEF, very likely it's going to go lower in absolute price terms. That means a negative performance. We would expect the dollar to strengthen on the back of that. At the moment, it's not doing that anymore. It was doing that very nicely. It's not doing it anymore. So I'm going to watch the development of euro dollar and the dollar index in coming days, weeks, to see whether it's going to catch up with those rising rates by falling. Euro dollar needs to fall for the dollar to strengthen, or the dollar index going up. So all in all, stock market under pressure, bond market under pressure, less so than stocks, preference for stocks, and difficult rotation for the dollar. Should be strengthening, it's not doing that yet. Let's move over to sectors and see what we find there. Again, the daily RRG on the right-hand side and the weekly RRG on the left-hand side. Markets are closed already, so this includes Monday, Monday the 7th of February, when you look at the performances. On the daily, let's look at what happened last week. We can see a strong performance for energy and for financials, followed by healthcare, staples, and then from discretionary down, all the sectors were in negative. Discretionary and industrials were still above the market because the S&P was down 60 bips, and discretionary and industrials were down only 50 bips. So more or less in line with the market. Real underperformance, real estate, we already saw that in the asset allocation section. Materials, technology, and once again, communication services. That's what happened last week. If you look at the tails in the RRG, you can see that they are moving predominantly vertical, either up or down. And when a tail moves vertical, that's a relative momentum-based move. That's not so much a change in relative strength. It's more it's relative momentum based. So it's very often a pause in an existing trend. So if you look at energy, it's detached from the rest. It's a very high level. It's in a pause in a relative uptrend. You could say the same about staples. You could say the same for utilities that are going down here. They're losing momentum, but they're not losing a lot of relative strength. Industrials is starting to lose on a relative strength scale. So if you look at discretionary, obviously Amazon, blowout figures, etc., etc., it's pulling that, it's obviously a big weight in that sector. It's a heavyweight sector. It's the lowest in terms of relative strength on the daily scale. It's almost vertical in a big move. It's not yet moving to the right on the RS ratio scale. So still one of the more negative sectors. If you look at technology, that is at a high RS momentum move. You can see that here, predominantly vertical. It's picking up a little bit on the RS ratio scale, but not much. And if you look at healthcare, that is inside the improving quadrant, but immediately started to roll over. So very short tail, not really much going on there. If we put that into a longer term perspective, then you can see the rotation for all the sectors here on this RRG. Last 5 weeks, big dispersion between the performance of the sectors. Only sector with a 5-week positive performance is the energy sector, and communication services discretionary down 7.8, 8.5%. That's a more than 20% difference in performance in a 5-week period. That's a lot. That's a high dispersion between those sectors. Now, you may have noticed that a while ago I started to break this RRG down into 3 groups: cyclical, defensive, and sensitive. And I following the Morningstar breakdown. I talked about it with Dave Keller when I was a guest in his show last week. If you want to look back at that show, then look that up when I was a guest in the final bar. We discussed how that works and why we would do that. And we are using the equal weight sectors because very often they give a better, they're less impacted by the weights of the individual stocks. I want to keep this in line with the sectors that we always use, the spider sectors. But here is the breakdown for the cyclical sectors. So these are financials, real estate, materials, and discretionary. And you can see that the only tail on this RRG that is positive is the one for financials. And we just talked about rising rates, etc., etc. That's usually a good thing for financial stocks, banks, etc. So no wonder that the financial sector is outperforming the other cyclical sectors. Mind you, again, minus 2.3 over the last 5 weeks. It's outperforming, it's in leading, but it lost 2.3% over the last 5 weeks in value, in absolute price terms. The other ones, real estate, materials, discretionary, all moving lower. Discretionary already crossing over into the lagging quadrant. Materials rapidly losing relative momentum, starting to slightly lower on the RS ratio scale, and real estate rolling over while inside leading. If we go to the defensive sectors, there I think this is the clearest picture that you can get in terms of market rotation. These are all inside the leading quadrant. They are all still moving higher on the RS ratio scale. Utilities just dropped out of that 0 to 90 degree angle that we like to see in terms of RRG heading. Staples are still there. Healthcare is crossing over into leading. We saw the weakness here on the daily scale, but on the longer term trend, it's still moving there. And if you look at the performance over the last 5 weeks, all these sectors have been outperforming the S&P 500 by at least 1%. So if one message is clear, it's that the rotation favors defensive sectors. And that usually doesn't happen when the market is in a bull trend. Now, the final group is what we call sensitive stocks. They're a little bit more mixed. They're sensitive to economic developments. And you can see here the super strong performance of the energy sector. And that goes against the weak performance for technology. You can see the technology tail and the energy tail moving almost opposite of each other. Industrials is sort of in line with the market, very short tail, very close to the benchmark, not much going on. And communication services is picking up in terms of relative momentum, but it's far away from crossing over. So I want to go over a few of these individual stocks, individual sectors, sector charts to give a little bit of color to these rotations. And the first one that I want to talk about is communication services. It's right here. You can see why it is doing what it's doing. Because after that steep decline in terms of relative strength, we moved sideways in terms of relative strength. We moved a little bit up in price, moved sideways in relative strength. That's exactly what you see here. That's that up move in relative momentum. And we just started to move lower. There's a little bit of a delay. So I wouldn't be surprised if we see communication service moving into improving, rolling over, and going back down, especially when it breaks below this 69.60 support level. There is much more room to the downside for communication services. Energy, strong breakout, both in price and in relative strength. That is probably, well, it is the strongest sector at the moment in the sector universe. Financials, threw a couple of curveballs over the last few weeks when it would threaten to break that channel, that support line here. It's now comfortably back into that rising channel. It looks as if relative strength is breaking out of this, above this falling resistance. So financials are back on track as an outperforming sector. Technology, again, another curveball. We dropped, we rallied, but we didn't get back. And that old support line is now really acting as resistance. We're hovering above this old resistance, now support in terms of relative strength. If we break that lower, and if we put in a new high here, we are going to see a move to 145 again. And if that breaks, then obviously there is much more downside to be expected. So I'm getting more and more concerned about the performance and the relative strength of the technology sector. Real estate, kind of similar. We already discussed that. Very hard to see that it's going to break above this resistance with a price chart that is doing like this. So we're looking for 44 support. If we look at healthcare, that's just like financials, kind of a curveball here. We dropped, we closed like on that support line here. We're now back in there. So it's not the super strength that you'd like to see. You can see that here in terms of relative strength. It's not doing all that, but it's not deteriorating any further, and it's back above its old support line. So hang on there for that healthcare rotation. And then finally, consumer discretionary, together with technology, two biggest sectors in the market. Double top completed. You see that dip here. We're not able to push back above that breakout level. We had that bounce. It's already starting to lose momentum. You see a rapid deterioration in terms of relative strength and relative rotation. You see that long tail moving into the lagging quadrant. So wrapping this up, sector rotation clearly favors the defensive sectors, and the two biggest sectors, consumer discretionary and technology, are not looking good from a relative perspective, and they're also not looking good from a price perspective. And this wraps up Sector Spotlight for this week. I hope you liked the show. Please remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. I hope to see you again next week, same time, same place.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.